on March 15, 2023, in algorithmic trading centers located in New York City. A routine update for the reporting system used by Infinity Capital, a prominent financial technology firm, was implemented. Infinity Capital specialized in high-frequency trading and relied heavily on automated systems for reporting transaction data across its diverse portfolio of financial instruments. The platform integrated with various exchanges worldwide, ensuring near real-time processing of vast amounts of trading information. The update was intended to enhance reporting accuracy and introduce new analytical features. However, the development team overlooked a crucial aspect of the update: interface compatibility with legacy reporting protocols. This resulted in a misconfiguration of the data flow, wherein erroneous transaction data began propagating unchecked through several interconnected systems. Additionally, the oversight included a weak logging mechanism that failed to capture errors resulting from the altered functions of the reporting algorithm. As initial discrepancies emerged, the automated systems continued to operate under the assumption that all data was accurate, further amplifying the inaccuracies down the line. This process gap within the data integrity mechanisms meant that problems magnified quickly without adequate human oversight. Vendors responsible for the underlying technology assets proved to be less responsive during this critical time, as their own systems were not equipped for rapid diagnosis of the newly generated errors. Internal tools that were expected to notify the operations team of irregularities were unable to flag the initial signs of incorrect reporting. By March 18th, just 3 days post-update, early symptoms began to show measurable impacts. Infinity Capital's algorithm reported a 15% higher volume of trades than actual transactions executed on the exchanges, attributing to a projected loss in profits. Moreover, an influx of erroneous data led to a 12% rise in unexplained transaction fees across multiple asset classes, creating uncertainty among institutional investors and clients. Initial estimates suggested that potential revenue losses could reach upwards of $5 million within the first few weeks should the issues remain unaddressed. Internal reactions varied. The operations team held hurried discussions in a dedicated incident channel, sifting through the reports to ascertain the extent of the inaccuracies. Some team members speculated about a minor bug that could be patched quickly, while others called for a deeper investigation into the update itself. Confused email threads circulated as technical staff sought clarification from developers who provided vague assurances that the issues would resolve after a restart of the affected modules. However, this effort ultimately only offered a temporary fix, failing to identify the real cause of the discrepancies. Users began communicating their frustrations on various trading platforms. Monitoring alerts triggered warnings of irregular trading patterns, escalating internal anxieties. Minor media outlets picked up on unusual activities regarding Infinity Capital, spotlighting the firm's abrupt halt in its normally high-velocity trading behavior. Online forums lit up with discussions as traders shared their struggles with unexplained fees and inaccuracies within their transaction reports. Prominent financial news channels began to mention the anomalies, speculating about the potential ramifications for the broader market. By March 20th, the situation intensified, as further analysis revealed that the flaws ran deeper than initially believed. Infinity Capital's compliance department flagged the faulty reports, realizing the implications of inaccurate data on risk assessments and reporting obligations. External auditors expressed concern over operational integrity, proposing a full-scale investigation into the reporting systems in place. confidence began to erode among Infinity Capital's partners and clients, who started to seek reassurances from the firm. Some institutions faced abrupt liquidity issues as they struggled to reconcile their positions in light of the errant data. The cascading effects on interconnected systems started to surface as other financial institutions that depended on Infinity Capital's data for decision-making began experiencing disruptions. As internal and external pressures mounted, senior executives initiated crisis management protocols. However, their advisories were clouded with confusion, as the source of the problem remained elusive. Analysts reported numerous misalignments across databases, emphasizing the urgent need for a holistic review of the organization's technological dependencies. Unfortunately, communication breakdowns began to surface as different teams operated under varying assumptions, further complicating troubleshooting efforts. As the gap between operational stability and market trust widened, the failures of Infinity Capital's automated systems caught the attention of regulators. The potential for systemic risk loomed large as anxiety rippled through the global financial ecosystem. A confluence of dependencies, oversight failures, and a lack of robust communication resulted in a volatile environment, creating a powder keg scenario that threatened to spiral into a larger crisis. Late on March the 21st, external partners began implementing precautionary measures to mitigate their exposure to Infinity Capital, foreseeing the possibility of a significant market downturn. The groundwork laid by the initial update had now set the stage for severe repercussions, but the chain reaction had yet to reach its peak. As uncertainty reigned, decision-makers at Infinity Capital were left grappling not only with the technical failures, but also with the looming question of how to regain stakeholder trust amidst escalating alarm throughout the financial landscape. By March 22nd, the situation escalated dramatically. Reports mounted that significant financial entities were now experiencing forced outages due to reliance on Infinity Capital's erroneous data. Liquidity crises rippled through the system as reliance on faulty transaction reporting led to a cascade of margin calls and settlement failures. Institutions found themselves unable to execute trades or access critical liquidity, further deepening the rift in global market stability. Some banks reported losses exceeding $10 million as they scrambled to cover unexpected discrepancies, and a number of hedge funds announced immediate suspensions of trading activity. On March the 23rd, regulators, alarmed by the rapidly deteriorating conditions, initiated emergency meetings to assess the situation. By noon, financial oversight bodies had issued regulatory warnings to Infinity Capital, demanding immediate transparency regarding the faulty update and its ramifications. Simultaneously, legal notices were dispatched to fintech clients who faced potential liabilities linked to misreported transactions. The gravity of the failures prompted investigations within the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, who began collecting data and evaluating compliance failures. Throughout March 24th, various financial platforms affected by Infinity Capital's data began deploying emergency protocols. Risk assessment teams analyzed exposures, while infrastructure experts probed potential anti-fraud measures. Yet many were operating on outdated contingency plans and timelines that prioritized speed over thoroughness. Unplugging systems that relied on Infinity Capital's flawed information further exacerbated the uncertainty in markets, leading to a massive sell-off, with stock prices plummeting. By March 26th, independent journalists, initially probing narrower aspects of the malfunction, began to uncover links between Infinity Capital's internal communications and their failure to adequately address the growing concerns regarding the update. Digital forensic analysts reported inconsistencies in recorded system logs that aligned with erroneous transaction fee data, revealing lapses in protocol adherence and testing before the implementation of the new algorithm. Simultaneously, leaked internal chats circulated among the press, illuminating a troubling culture of neglect when it came to operational integrity. Specific discussions highlighted repeated warnings that fell on deaf ears, with a prevailing mentality that prioritized rapid deployment over exhaustive checks. This evidence prompted further scrutiny regarding Infinity Capital's governance structure and risk management practices. By the end of March the 28th, multiple parties, including internal auditors and external investigators, gathered to navigate the fallout, analyzing the magnitude of the crisis with close attention. Early estimates revealed that losses had exceeded $50 million across multiple platforms, exacerbated by hostile responses from shareholders who accused Infinity Capital's management of incompetence and negligence. Subsequently, on March 30th, the financial authority suspended trading for Infinity Capital while initiating the formal process for audits and evaluations. On April 1st, law enforcement agencies were brought in to support the investigation amidst allegations of potential fraud. Business operations underwent intense scrutiny, with subpoenas weakening the foundation of confidence and trust that had enabled Infinity Capital to thrive historically. Company executives faced escalating pressure, resulting in several resignations from upper management who opted to step down rather than navigate the mounting legal liabilities and reputational damage. The exposure continued, as financial reports revealed links between the flawed update and ongoing trades within hedge fund strategies, illustrating how pervasive the inaccuracies had become throughout the ecosystem. As of mid-April, various brokerage platforms began issuing client notifications, advising of potential delays in trade settlements and urging caution amidst the upheaval. The repercussions unfolded further through the coming weeks. By the end of April, many institutions had initiated legal action against Infinity Capital for damages incurred. Outsourcing responsibility through public disclosures and financial reconciliations failed to soothe the growing discontent, and affiliate companies reconsidered their associations with Infinity Capital, leading to a market exodus that compounded operational strain. In May, a judicial injunction was placed against Infinity Capital while an extensive audit of their systems took place, revealing long-standing vulnerabilities in their automated reporting structure. Financial difficulties and lack of risk oversight led to speculation around potential bankruptcy filings, which commenced in early June. As dominoes continued to fall throughout 2023, Infinity Capital was declared insolvent by the court on July 15th, after failing to secure adequate financing or restructuring plans. The company's assets were liquidated, stemming from litigation that accused it of gross negligence. The financial systems that had become heavily reliant on it faced an irreversible loss of operational coherence. By late August 2023, significant policy shifts began to materialize across financial institutions as an immediate result of the crisis, focusing on enhanced auditing frameworks for automated systems. Regulatory bodies mandated stricter compliance measures to avert similar failures in the future, emphasizing accountability and minimizing reliance on unverified technology. On September 1st, 2023, With Infinity Capital now defunct and a significant wake of systemic failures in its past, stakeholders remained focused on rebuilding the fragmented trust within financial markets. The global financial landscape faced substantive transformations, firmly marked by the collapses and failures brought forth by one overlooked automated update. Final legal resolutions revealed no further liabilities existed for stakeholders moving forward, leaving the firm marked and irrevocably shut down.